Morning trading. We're joined by Dan Geltrude, managing partner at Geltrude & Co. Dan, the S&P trading at record levels after kind of hitting a record yesterday, of course, and investors are reacting to kind of this positive headlines that we're getting around COVID-19 prevention. We just got the CDC mentioning, of course, obviously that lower time frame for quarantine. The momentum, do you anticipate the Santa Claus rally kind of fading anytime soon, or do we see the rally continue on the tide that we've seen?
I think it's really going to depend on where Omicron takes us. I think the market got a little bit spooked a couple weeks ago related to where this COVID variant was going to take us. But as we're seeing, although it is spreading at a significant rate, we don't see people getting as sick, which is good news. But it's really about what is the reaction to the COVID variant that is really going to dictate how the market reacts. And what I mean by that is, of course, shutdowns. And it seems that governments are resisting that and much more going along the lines of pushing people to get vaccinated as opposed to shutting down industries. Now, I think if we see that trend continue, I think this market is looking to go on another run. But again, we just don't know where COVID is going to take us. Yeah. Let's hope that what we're seeing right now in terms of this significant spread is going to mean that we're finally getting to the end and we're going to have true herd immunity and put this all behind us.
Yeah, we've all got our fingers crossed on that. I want to ask in terms of near-term risks to the market, what do you see? Omicron, the most obvious risk there, in COVID-19 in general, but are there any others?
I think we're going to have to see what the Fed does next. Now, they're talking about increases in the interest rates. Now, I believe that if we're going to have any type of significant increase in interest rates, that is going to have a large impact on the market. I think what we're enjoying right now as far as this incredible market goes is that investors are looking as to where they can place their money. And with interest rates so low, it really doesn't give investors much of an opportunity to really go anywhere else besides the market. And with inflation how it's been, and I don't believe that inflation is going to be rolling back anytime soon, investors again are forced to look to the market because that is the only thing that they could really invest in right now that's going to keep up with inflation. Anywhere else that you're looking, certainly bonds and CDs and those types of things, you are going to be losing money every single day. So I think investors are somewhat in a funnel that's pointed directly to the market, and I think that's going to last for quite some time.
Does it last until we get those rate hikes?
I think it does. I think unless we have some type of black swan event, I really think that the market is poised to continue to rise as we've been seeing. Now, listen, there's going to be some choppy waters ahead, no question about that. But overall, I think that the market will continue to move forward, quite frankly, at a nice pace.
Yeah, let's pivot to sectors here, with many sectors, of course, hitting all-time highs. I wonder, as we kind of turn the corner into the new year, we got to start thinking about taxes, right? How should investors be looking at capital gains from a tax perspective?
Well, this is an interesting scenario that we're in, right? Because overall, when you think about taxes, you're always thinking about, how could I defer income? How could I make sure that I'm accelerating as many expenses as I can and deductions and so on? But we have a scenario now where Build Back Better is looming in Congress. Now, I believe some form of that bill is going to get passed. And if and when it does, there's going to be tax hikes that go along with that. So I think we have to look at this situation and say, taxes are clearly not going down. So do I take those capital gains this year when you know what the tax rate is going to look like, as opposed to deferring that and then looking at probably much higher tax rates? And I think that you're seeing some investors have been reacting that way. So that is really contingent upon where Build Back Better goes. But overall, what I'm seeing in terms of many businesses, they, to the extent they can, they're looking to accelerate income into 2021 and assuming that 2022 is going to be a higher tax year.
Yeah, to your point, we have seen kind of C-suite executives, most notably, kind of cashing in some stock. To your point, we know what the tax rate is right now, may not know what it is next year, and it most likely is going to be higher. Continuing with sectors, though, here, despite being up over 2% for the year, the NASDAQ, that is, I believe, consumer discretionary and financials are kind of the laggard industries in the last 4 weeks. What is your take on the strength of consumer spending in the credit industry, just given the inflationary pressures that we're dealing with now and into next year?
Well, it's really not about consumer spending, right? Because the demand in this formula in terms of supply and demand, the demand is there. People want to spend. The problem is related to supply chains and being able to have products and services to be able to purchase. So I believe that really we need to be focused in on across the board, meaning in industry as well as government, as to what we do about supply. Now, a lot of the supply problems have related to labor shortages. So again, we circle back to COVID. COVID is what has kept many people, many laborers on the sideline, not just in the United States, but worldwide. So again, if we can get past the Omicron variant and we can make some headway and progress there, I think we'll see a labor start to come back. And with labor, we can solve the supply problem and get much more to equilibrium in terms of supply and demand, and naturally inflation will start to reduce at that point.
Dan, before I let you go, the NASDAQ has jumped over 2.2% in the past 4 weeks, although it's down right now about 0.1%. What do you see as the biggest risks to the tech sector? Is it the rate hikes, coming next year, or something else?
Well, I think, again, that the rate hikes are definitely a risk out there for the value of equities. But overall, look, I believe in the technology sector quite strongly. I believe that's the future. And the long-term play is to stay in technology. If you look at all the advances that we're making across the board, because technology ultimately impacts every single sector, I think that is a good place to be. I would be telling investors, look, buy on this dip related to technology, because technology is not going anywhere. This is something that's permanent, and there's going to be a constant evolution of new things and ways to advance. And I just think that's a great place to be. Again, you got to come up with a strategy and ride the wave.
So tech, a great place to be. And before I let you go, I got about 30 seconds left. Which industries do you see undervalued at this time? I don't think many people would argue that tech's undervalued, although many would argue there is value there for the long-term investors. But in terms of undervalued plays at the end of this year, going into next year, what are they for you?
Well, I think that the financial sector right now is probably undervalued. But again, you kind of have to have your sea legs for that one, because I'm not necessarily sure that we're gonna realize the value in those stocks right now. But again, I do like the financial sector as a long-term play. I think there's some undervalue there.
Dan, as always, really appreciate your insight. Dan Geltrude, managing partner at Geltrude & Co.